Okay, folks. So could I just ask everybody to put their microphones on mute unless you're going to ask a question, because we just get interference here on our side, which would be great. And then, as per usual, just jump in if you've got a question at any stage. Just jump in. So just before I kind of forget, I was asked just to have a look at 3 different stocks, so I'm going to start with them straight off the bat. And as per usual, I would love if any of you had any questions, just jump in at any stage, and then I'll get to the S&P 500. So the first one I was asked to look at is Micron, and so we look at that from a technical perspective, and then I'll look at it from the fundamental perspective. So serious run up, and I think we had a number of clients in this stock, and we kind of suggested to kind of offload it and take the profit off the table. So anytime you see a run up like this, folks, usually some of it is given away before it makes a retest at a high. So just from a technical level, I would expect Micron to try and test this again. And one of 2 things is going to happen. It's either going to bust through it and then you stay in the game. If it doesn't bust through it and starts falling back down again, it can be a sign that, you know what, the market has got exhausted on this. So just to give you a previous example, here's an example of a high. You can see a pullback, made an attempt at it, didn't quite get there, made another, and then broke through. So the point I'm trying to make here is that that high here took out this high down here. That's what you want to see, just from a technical perspective. Now we jump into equity scan and have a look at what our systems say on it. We're saying that it's kind of fully valued here, and we've a higher target price, as you can see, relative to what the analysts are saying on average. So based on technicals and based on fundamentals, I'd probably be taking my profit off the table on this stock. So Clive, if you have any specific questions on that, please jump in. But that will be my tuppence worth on it. The second one was Terra. Now I'm trying to figure out which one exactly it is.
That would be the Terodyne.
Terodyne. Okay. Give me 1 second. Okay. So if you're in that, Clive, congratulations. You've done very, very well. I'm actually not sure if this, I haven't followed this stock, to be quite honest with you. So I'm not sure if it's in, it's not in our equity scan, but I'm going to show you just a couple of things that I will be looking out for very quickly here. So technically speaking, Clive, and something like this is happening, we're making new highs all the time. This is a what I call an exponential move. I would expect it to pull back at some stage in the near future, but probably, again, like the previous stock, I retested a high. But I'm going to have a quick look at the financials for you here, just to give you my tuppence worth. So again, this is my first look at this stock. I don't follow it, so I'll just hold my hands up on that. If you look at operating margins, it's one of the first things I always go looking for, because if operating margins are improving, usually investors will give the company higher valuation multiples. You want to see operating margins improving, and you can see they actually, in the recent past, in 2021, it was up significantly higher. Maybe that's an overhang from COVID, and it kind of trended down, and now it's stabilized, and they're actually improving in a big way here. So on the operating margin side, that's a big plus. I also have a quick look here and look at shares outstanding to see, is the company buying back its own shares or are they issuing shares, and it's pretty stable, so there's not a hell of a lot going on there. And then I have a quick look at their debt ratios down here, debt to equity, and it's fairly stable, so I'm not worried about that here. So now I'm switching over on the profitability side, and we're looking for anticipated future growth. So you can see here in the past, this is 2023, 24, 25. Yes, earnings per share is relatively flat, but a big jump expected into this year, and the growth rate looks like it's going to continue substantially. So that's the reason why the share price is jumping the way it is. And sales is growing substantially as well, by over 20% a year by the looks of it here. So from a sales growth perspective, an earnings growth perspective, it looks great. Operating margins looks great. debt looks great. So everything looks great about this right now. So now we get into the valuation part. And this is what we're trying to guess now, that kind of move in the stock price, if I just go back here, is it already factored in? Are all those good fundamentals we just looked at already factored into this share price? And the best way to try and guesstimate this is to look at historical valuation multiples. And we're going to give it a bit more. And the reason for that is, if you look historically here, it's pretty much traded in the mid-20s in terms of a PE multiple. Recently, it jumped up. Ignore this one just for the moment. And you can see the price to sales has jumped up dramatically recently too. So the market is already given a higher multiples. You can see that clearly happening here for the future growth rate that's coming. So the market is priced in quite a lot here. So what I tend to do is I look at the earnings per share 2 years out, and I can see it's coming in at 843. Now, if I was to apply a 30 multiple to that, you're talking about a $240 to $300 share price. Okay, we're already there. So you can see the PE multiples. We're already we're kind of on average. We're already baking in that for 2 years' time. So my thing would be to suggest that a lot of good news is already priced into this, but at the same time, you can't beat momentum. It's foraging higher. So if I was in this stock, I would probably stay with it until I seen the first sign of weakness, and then I would bail on it, because I'm just seeing that a lot of the good stuff is priced in. And that's without me knowing a lot about Terodyne. I'm just looking at numbers here. So, Clive, if you've got more insight into Terodyne and you see something, you know, stuff about their products, like we did with Google, for example, that would come into play as well. Okay. And then Western Digital, that is a stock that's on ours radar. And you can see there, we're kind of showing overvalued. Now, our valuation is a lot lower than what the analysts are giving it on average. But even with that, we're getting quite close to the analyst target price. So looking at this here, that's really positive, by the way. New highs, and then we're getting this consolidation here. That's quite positive. So if you're in that, you could probably stick with it until it reaches your analyst target price. But our models are suggesting this might be a little bit overcooked, or getting to that point where it might be overcooked. And I have a quick look at financials. Nice growth rate as expected. Anything that's trading up that high, you would expect to see these numbers grow. So for me, Western Digital, again, it's made a big move. You could probably stay with that if you wanted a little bit longer. But all of these have made significant moves. And if you've made your profit on them, you've got to weigh up how much of the good news is really priced into this. And for me, on the spot here, it's very hard to say without getting under the hood in each of those companies. Is that okay, Clive?
Yeah, that's fine. Thanks very much. The Terodyne I was into a week ago and sold calls in that. So I went to Western Digital there, and it actually sank and was saved by the jobs report when, you know, the market went up again. So it was sinking earlier in the week. But, you know, it seems like you say that it's already done the good, you know.
Yeah, a lot of the times when you're catching this type of a wave here, you're getting in at the latter end, Clive, and the risk is, let's say this decides a healthy correction for this will be down to this 50-day moving average, right? So you could be looking at this pulling back from where it is right now. The guts are 22%, and it would still be just, I would classify that as a healthy correction. So that's a big drop, you know, and that would still be in an uptrend. Now, what I would say to you, when you're investing in stocks for the long term, that's not a problem to me. You don't like to see it, but you're investing for the long-term wealth in the company, okay? But if you're trading this, I would be anxious here if I had a trader's hat on, because I'm going, God, for that to come down to support, that's a 22% drop. I don't want to be hanging around for that, you know? So with a trader's hat on, I'd say exit. With an investor's hat on, I'd be saying do your homework and your due diligence on the stock. Does the valuation add up? Our model suggests it's fully valued. That's just our models. It doesn't mean that you don't have any further insight on the stock, but we're just basing it off numbers, if that makes sense. Okay, unless there's any questions about that, guys, I'm just going to have a quick rundown on the S&P 500 because I had a great conversation on a mentoring session earlier on with Irene, and I just thought it would be good to maybe open up that discussion for people here as well. So last week, when we were doing the mentoring session, if I go back, we were starting to have a couple of down days, and I was kind of getting excited because I thought it would be great learning for you guys to see a position come under pressure and how we handle it. As it turns out, the market just reversed course. But I did release a video showing you what we would do in the event of something going right or something going wrong. So what I'm going to do now is just share with you, well, where we're at right now. So you can see Interactive Brokers, we're up quite substantially on that XSP trade. Again, please remember, these are all based off 10K accounts. If you obviously got larger accounts, the numbers are going to be different. So I'll talk in percentage terms. This is a 1.4% return in less than 10 days on XSP on our Interactive Brokers account. And when we switch over to our IG index account, we're up €288, which is about 2.9% in the space of 10 days on that, okay? So there's nothing to do with those trades, guys, except enjoy the profits. Let them run to expiry. And I just want to share with you what that means. So I'll start with IG index. You can see here the latest price here is 659. We've got a bet size of 20. So we still stand to make on this trade another $130. So it's 20 times 660, okay, which is roughly $130, let's call it. In euros, let's call it 110 euro. So another 110 euro is probably going to go onto our profit column here between now and expiration Friday on the 27th. So that's the reason why we're not closing down the trade. We're going to let it run, okay? Because we've over 1% to gain on this. And again, if you have a much larger account, that's going to be multiples of that, okay? And it's similar here for the XSP position, which is basically the same strategy, just with a different ticker on Interactive Brokers. And you can see here the market value here is $64. Again, it doesn't sound like a lot, but that's 0.6% to come into your account over the next 10 to 14 days. So we will let that run to expiry. So what I mean by that is this is going to disintegrate to zero, which is great for us. That's what we want because we sold the put option. And as long as the S&P 500 stays above 6,400. And at the moment, that's shown a 99.5% probability, by the way. Okay. So nothing to do in those trades. Happy days. Let them run to expiry. And hopefully the message is sinking in, especially for new people, why this strategy is one of our preferred ones and why it delivers consistent returns. And that's what I want to go back and have a little chat about, because I had a really good conversation with Irene. I thought it's a shame it wasn't on this platform. I think everybody would have benefited from it. But on the mentoring session, I was just showing the difference between selling different strike prices. So, for example, the blue line I have down here, that's our existing trade we've got on the US 500. We've sold the 6,400 put. But what we did was we came up here to the 6,800 put. And we sold the put option there in a demo account, just to show the differences between the two. And the conversation morphed from, okay, I see you've done the 6,400, high probability, but the probability is really high here too. So if I was to go in and place this trade now, for example, it won't let me place it, but let's pretend I'll use SPY. And you're going to see the probability here is going to be like nearly 70%, I think, something like that. So I'll do the 680 strike. And it's actually 81%. So the question to me was, Stephen, well, why aren't we picking the 680 strike? Look at the premiums we're getting in here. They're much higher. And that's absolutely correct. So if you think about what we're doing here, I want to bring it back to basic terminology. We're ultimately selling insurance on the S&P 500. Just think of it like that. And the price of the S&P 500 right now is nearly up at 7,000. Let's keep the numbers easy, call it 7,000. Right now, we sold an insurance policy for 6,400. We could have sold this insurance policy for 6,800 and taken in even more premium, and we would have got a much higher return on investment. Having said that, we have less wiggle room when things go wrong. So I want you to cast your mind back to last week when this was starting to happen. And our 6,400 put down here was starting to show a loss, if you remember that correctly, which will be right when that's happening. But look at all the space we gave ourselves for this to continue to go wrong. It could have fallen another 7% and we still would have made money. Now, if we'd have sold the 6,800 put, it would have been interesting to see what our psychology would have been last week when this was happening. We would have been in taking evasive action, maybe closing down the position, panicking, etc. And that's the difference between the two. There are option traders out there who will sell at the money puts. They won't even go down they won't even go down to 6,800. But they're skilled option traders who are trading every day. They know what they're doing. We're trying to create a strategy that delivers consistent returns over time. And this all boils down to statistics. So we're invested into we're trading a diversified instrument. That's risk management number one. Risk management number two, we're saying we're not interested in anywhere near it is, but we will insure it down here. So in other words, we can win if it goes up, sideways, or down. That's risk management number two. And then risk management number three is, well, what if the SH1T starts hitting the fan? What are we going to do? We had a plan and an alert out that if the S&P 500 hit 6,500, we would just buy ourselves out of February and then open up a March contract, but down for a lower strike, which is called rolling out and down. And that would have brought our break even well below 6,000. So you can see the strategic approach that we're running here on this S&P 500 trade. And whilst you do get paid more for bringing your strike up, think about it. If you're insuring something for more money, you'd need to get paid more. If we're insuring it for less, you get paid less. So there's a balance here to be had. And in my opinion, having done it for a long time, you're better off sticking with the statistical approach that I'm applying. And the reason for that is, if our goal at the end of the year is to get 30% on this account, well, if we delivered 4% in this month with our using this strike down here, why would we tempt, I suppose, fate, taking even more risk up here? To me, we can get to our goal in a least risky way. So it really kind of boils back to what is your goal at the start of it all, okay? So I've done a lot of talking on that. I'm hoping you have questions. If you want to jump in there now, go for it.
Yeah, Stephen, question for you. So my understanding is when you back tested the strategy, something like 87% of the trades worked. 7% needed to be rolled out and down, so they're break evens, and then
they actually turned profitable. They would have been profitable because we were rolling them out and down at a credit.
Okay, fair enough. Okay, and then the other, whatever it is, 6% of the time, you're going to lose. And what happens there is so let's say the market's moving down, but hasn't yet hit the 6,500 that would trigger our corrective action, and then it suddenly drops from there, and we end up basically taking the hit. Isn't that correct?
Okay, so first of all, if let's say for argument's sake, Brendan, just to try and bring this into some form of reality for today, let's say we had a 6,700 put up here. I'll just draw a line there, right? And hopefully this will answer what you're asking me. So let's say we go to 6,700 and we had a strike up here. Now, we wouldn't in real life, but let's say we did. And all of a sudden, I don't know, there's bad news out, market starts to dive. And if we don't get time, in other words, let's say this just starts rapidly doing this, then once we've gone in the money in the put, in other words, when the price is below the strike, at that point in time, we can't roll out and down. So with IG index, we're probably going to roll out and down. We'll have, because it trades 24/5 Sunday night to Friday night. With interactive brokers, you won't, because options trade 8 hours a day. You know, they don't trade 24 hours a day. So you probably won't get your chance to roll out and down, which is what you're saying to me. So what do we do in this scenario? And this is where you use your own intuition at this stage. So you either decide to close it at a loss, walk away from the trade, or you can decide to stay in it if you think, look, that news isn't too bad. So a great example would go back to here. Last year, was, I suppose, when the tariffs were being, I suppose the world order was being shaken in terms of tariffs. And you can see there, like one down day there, that's a 4% down day. And then the next day was a 5% down day. So that's a 4 and a 5% in a row. So this is pretty much what you're talking about here. So we would have been rolled out and down on this one, right? And using the US 500 strategy. But if I'm being honest with you, Brendan, if, for example, I was in interactive brokers and the rollout, I couldn't get it done in time, I would have exited and taken my loss on the first day. The reason is, think about what the news was. The, you know, trade relations as we had known in the past were being ripped up, and we had no idea what was going to happen. So we probably would have taken a loss here on the first day back here, if that makes sense. So a lot of it will actually boil down when this happens to, well, what is causing the market? Is it a natural correction? You might decide to stay in it then, or is it just a case of, no, I'm being disciplined, whatever the loss is, I'm walking away.
So what I'm trying to understand what the downside risk is, okay? Because the theoretical risk is enormous, obviously, because the market can drop very substantially, right?
Yeah.
But I'm trying to understand. So if we were doing this for 5 years, let's say,
yeah,
you know, how much would you be building in for the size of those losses when they happen? And that's what I'm trying to get my head around.
Okay, so like even if you go down here, so let's take this as an example. Let's imagine we're here now. So that's a 10%, and over those, that was a 10% move over what, 3 days there. Okay, we would have rolled out and down in the US 500 challenge. We would have been down below 6,000. So we wouldn't have got caught here on the US 500 at all. We would have rolled out and down, if that makes sense, because it trades 24/5. So, but let's say on this one here, there's your 4%, and we're now as well imagining we sold the put here at the worst possible time, and then this happened, right? That's a 4, let's call that a 10% in total, right? But if you look at happen within 3 days, we were actually back up pretty much. So I'm assuming your worst case scenario on this one would have been, like, it depends what strike you're picking. It's very hard to say. But if you were worst case scenario and you got out at the worst possible time and everything like that, absolute worst possible time, it would have been 5%. And that's worst case scenario on this particular move back here. Because don't forget, you're out of the money. Like the strike we picked back here, where we're out of the money at the moment, 7% when we placed it. So we were already had given ourselves 7% leeway. And then if we didn't roll out, for example, we didn't get a chance and then we exited at the worst possible time, that's another 5% lower than that. And that's would have been that tariff turmoil there, if that makes sense.
Yeah, no, 5% would cost you a fortune, wouldn't it?
Yeah, but don't forget, you've made 4% in a month, this month. Do you know what I mean? And you're talking about an event that happens once and many times. Do you know what I mean? Like, how many times has that happened?
Yeah, but I'm trying to understand how much you would lose if it did happen. And like, I know it's trading, you know, 24/5, but we all go to sleep, right? So, you know,
yeah,
you could miss it, you know.
Okay, but assuming, and I'm saying in this example, assuming the worst case scenario, in other words, you sold the put at the worst possible time and you closed it out at the worst possible time. In this scenario here, it would have been about 5%.
But 5%, how many points is 5%? Say, if I take 5% of, what will I take it up? 6,000?
So you need to explain what you're talking about there to me.
So how many points is a 5% drop in the example you're looking at? About 300?
300 points on the SPY, is it?
Yeah.
On the S&P.
Well, no. Say if you're doing it on IG.
Yeah, it'd be about 300 points.
Yeah, so 300 points, and you were doing on the test account, you were doing $20 a point, right? That's 6 grand to be down.
6 grand if only if you didn't roll out and you closed out at the worst possible time.
Yeah.
Back here.
Yeah, and the size of the account is 10 grand.
Correct.
Right. So you're getting I'm trying to just get a feel for what the downside risk is.
Yeah.
I know it's difficult because there's so many ways it could play out.
There is, and this is the reason why on the conversation earlier on, I was saying you're better off having this large wiggle room here, which in our case, when we put it on, was 7%. So it was a big drop. And then having the strict trade management rules in place. What you're saying is, Brennan, if I think I'm right, well, what happens if I'm asleep? I wake up the next day and the market is down 10% in one day, 7 or 10% in one day.
Just bear in mind the way it could happen is the market could turn down, but it hasn't yet hit our action point at 6,500.
Yeah.
Right? Say it's just above 6,500. And from there you get a sudden drop.
Another drop down. So that would be, so even at there, you're talking about, okay, another 5% from there. That's true, and that can happen. So it's how would we manage that in that situation? You've got a number of choices. You can take the hit straight away. You can roll out and across. You won't be able to roll out and down because you're gone in the money now. So in that situation, you would be just rolling out and across and extending the time frame, giving it a chance to recover.
Yeah.
Another way of doing this for people who don't like that is turn this into a bull put spread. And a bull put spread is where you buy an insurance policy underneath it. So the benefit of that is your risk is absolutely defined. So for example, you could sell the 6,400 and then buy the 6,300 underneath it. There's only one downside with that. The premium you take in isn't as big, obviously, because if you have to buy an insurance policy underneath it. So for people who will be thinking in those ways and think, oh, look, I don't have time to react here, that would be the safer option for you. And or you just do a smaller size on the trade.
Yeah, I looked into the bull put spread, and the premium is substantially less. So for my non-pension account, I prefer the cash secured puts.
Yeah, like, I mean, you can look at it two ways in terms of so just to explain what a cash secured put is versus just the short put. So a cash secured put is where you actually take assignment to the shares. So again, like if you're doing this in Interactive Brokers and you take out assignment to the shares, you kind of say to yourself, well, I'm in the S&P 500. The recovery time is whatever it's going to be, and I'll just hold on to it, and away we go. We'll let the shares come back when they do decide to come back. So you can apply that at that moment in time. Where it's not cash secured, in other words, we're doing a return-based strategy like the US 500 or what we're doing with XSP. In those situations, you would just switch to, when you think the market is going to rebound, to actually switch into buying call options or to going long outright on the stock itself. So there's two different ways of looking at it, how you would actually handle it. But if it's a situation that you're not comfortable with, oh, I don't like the idea, just in case there is you know, a 2-day event or whatever like that, then in that situation, a bull put spread would be a better strategy to apply. But like, all I would say to everybody is as well, don't forget here, like if you're long on stocks here at this point, your losses are going to be worse because obviously you don't have the wiggle room for things to go wrong, you know. So it depends what way you look at it as well. So I mean, I would rather have the statistics and the maths in my favor over time and just get very disciplined in managing moves when they happen. If it's a situation where, okay, I don't like that situation, maybe you increase your rules, Brendan, in that situation to 2 or 3%. So for example, if you've gone 7% out of the money and then the S&P is within 2% of your strike, then you might decide to roll out and down. Don't wait for it to get within 1%, if that makes sense.
Yeah, thanks.
No problem. Any other questions on that, guys?
Yeah, why can't you run? Oh, sorry, you go first.
Just when you look at the two questions, one is in relation to Brendan's, and I guess I have the same fears as Brendan, but get over them. You know, if you had to go to a circuit breaker, if you had to go down 20%, I mean, that's where IG would kill you if there was a big breaker down. But as you say, it doesn't happen, only on a rare occasion. And for me, I'd like to see it happen and lose a bit of money because I want to get into the S&P. So IBKR is probably better in a lot of ways because you're better getting assigned. But you know, it is a little bit fearful in IG. You really want to be aware of what you're doing in IG, because I think the losses can mount up, especially if you're up trading off a 50 or 60,000 account. So hence I play it quite often, get out quick, in again. I got it in and out a couple of times with the breaks that are coming. And the second thing is, if you look at the top of the S&P now and draw a line across the top of there, you know, are we in a situation where it hasn't broke really above those levels and we hit it a few times? Are we looking at maybe breaking down before we go ahead again? Or what's your gut feeling on that?
Okay, so in relation to the S&P here, yeah, this is what you might consider a triple top. It's kind of, it's not really doing much. It's kind of just consolidating sideways here. Personally myself, and it's only your best guess, Jerry, on that, I think we're going to get some sort of a pullback in the first half of the year. If nothing else, just to bring in fresh capital into the index, or when I say the index, into stocks in general. But the rally is broadening out. So if I was to bring up, I'll just bring up a chart of the QQQ here for a second. And you can see the QQQ hasn't really performed since last October. So if I go, there's the high of the QQQ last October. If I go to the S&P 500, the S&P 500 at least put in a new high since last October. So what that's telling you is technology stocks haven't performed as well as the broad market index actually in the last 6 months. It's actually, and that tells me the rally is broadening out, which is a good thing, because it was pretty much the Mag 7 focused, and then other tech really up until that point. Obviously, financials have participated, healthcare started to participate now, and energy as well. So that's a broadening of the rally. So that's healthy for the market. But I do think at some stage, Jerry, we probably will get a shakeout, and it's only a guess at this moment in time. And technically speaking, this looks like we're kind of just treading water here at this moment in time. We're just going sideways. So my best guess as to what a shakeout would look like, it's probably around 64, 6,500. At that point, I will be going very long on the S&P. I will be buying into it unless something changes with the US economy. And that's the only thing that would change my mind. Or, of course, if there's a geopolitical event, we've got to consider. On the risk element, again, you're absolutely right on Interactive Brokers versus IG Index. IG Index is return-based. Interactive Brokers, well, if you got to sign the shares, what you're saying there is, well, you know what, I'll just hold on to the shares until they rally back up. So we're talking now really bad situations. We're talking bad outcomes here. Whereas with IG index, you probably have to go to a long strategy then, at that point in time, if again, worst case scenario stuff happens, you know. So you need to be aware of that. You're absolutely right. Interactive Brokers gives you the ability to take the assignment of the shares if you choose SPY, not XSP, of course. Whereas you're not getting that in an IG index, and that's where the risk management comes into play. And again, when you're putting on the trade initially, it's selling the puts way out of the money and giving yourself time to roll out and down.
I think you just need to get the comfort feeling.
Yeah, absolutely. Absolutely. And everybody's different, Jerry. Everybody will be different on this and what's suitable for them. But statistically speaking, either way, the short put strategy just on its own with SPY, if you did it the cash secure put way, it's statistically a safer strategy than buying the index outright itself. You know, that's just statistics.
So Stephen, it's Stephen Gavin here. Can I just mention something? Can you hear me okay?
Yeah, can you hear you, Stephen?
Yeah. I was just my own research just on S&P alone. I get it. You know, the comfort factor being way out of the money and so forth. And I'm not risk averse, but I don't think I'm a complete idiot either. But looking at numbers, even from the early 60s, you know, looking at about 15,000 trading days, the amount of times in one day it closed more than 5% lower, if you will, is 21 days out of 15,000. Even after September 11th, on September 12th, it closed 4.9%. You know, when Lehman Brothers filed for bankruptcy, closed 4.6% lower. So, you know, there are, you know, statistically speaking, in my opinion, you know, and you know what to say about opinions, that there is room, I believe, in that 5% out of the money to sufficiently get in time ahead and move yourself to a point out and down and protect what you've got, and even go in for a credit. Because how many times has it closed more than 10? From what I can see, once, Black Thursday in '87. You know, there's a lot of it in around 2008. Granted, 7, 8, 9% kind of thing. So it just from a simple numbers perspective, you know, it's possible, I think, to be able to get in good time and protect what you've got going on. But then again, you know, like I said, if someone's in bed or you're on an aircraft or something, you're not, you know, able to reach and do this, then yes, fair enough. Then we're all different in that way. But just from a simple statistics perspective, it does appear to be quite a manageable thing to be able to do.
Yeah, and that's it. If you looked at pure statistics, Stephen, you're absolutely right, 100%. And fair play to you for doing all that research. And that's what you really, you know, it's a great thing to know all of that. But I suppose you have to understand as well, there's no such thing as a free lunch when you're investing, no matter what it is. And no matter what anyone says, there's always risk attached, and it's up to everybody individually to assess, well, what does that risk look like for me, and am I okay with that? And then I suppose the most important thing is, well, how am I going to manage it if it starts going wrong? And that's why I suppose last week, when we started to see a few down days, I wanted to put that video out. I was hoping, and again, people will look at me as if I'm 10 heads with this, I was hoping it would actually come down a bit further in order for me to demonstrate what you would actually do in that situation, because I think there's more learning in that than the thing just going right all the time. But you're right, it's in a very, very rare occasion that you're not going to get a chance to roll out and down. And that's where actually, in my opinion, IG using that platform gives you more opportunity to roll out and down, because it's trading 24/5 versus Interactive Brokers, which is only, the options are traded out 8 hours a day and that. So the only, I suppose, upside to the Interactive Brokers, in my opinion, then, is that if you do use a cash secured put, you're taking assignment of the asset. And if I'm holding the S&P 500, I'm not going to lose any sleep over that. But I can understand when you're looking at your trade size and everything like that, you've got to evaluate that for yourself. What am I comfortable with if it did go wrong? What am I actually comfortable with? Yeah, that's brilliant questions, guys. This is where we learn from each other. So absolutely thrilled with that. Any other questions on the S&P before I move on? I just wanted to mention a little bit about Bitcoin. We were having a conversation with a couple of people about Bitcoin. Now, you know I don't trade Bitcoin, but I'm just giving you my tuppence word from a technical perspective. Like these are new lows it's creating all the time. My view is that the low it recently put in, there's going to be a retest here again at some stage. Where the next low is, it's probably a 55,000. It's down around this area here. It's hard to predict an exact bottom on it. And again, I'm not a trader of Bitcoin. I've no interest in it. But I just thought I'd mention it because a lot of people are asking me what my opinion was, technically speaking. Just moving on to the metals quickly. Again, silver, this kind of, again, a lot of people involved here with gold as well. Like, I know we did a webinar on this day and I was asked the question, I felt, look, if I was a trader, I'd take it off. I didn't have a Nostradamus hat on me or anything like that, that knew it was going to sell 30% the next day, but it did. So look, I never thought that was going to happen either, if I'm being brutally honest with you, but I always felt it was going to give up a lot of those gains. I didn't think it would happen in one day. And all I would say is, like, there's nice consolidation here. Understand what the fundamental drivers of silver are. It's, first of all, it gets brought up with gold along with it. So if gold's going up, silver goes up. We know central banks are buying up gold. So that's a kind of a lot of an answer as to why gold's going up on the supply side as well. And obviously the geopolitical risk that's out there. Other things going on with silver. China export curbs on silver, obviously that reduces supply, which has caused prices to go up. We know renewable energy and everything else that comes with that, and the demand for copper and silver is significant as we move towards that. So the question is, you know, something that was trading at 40, all of a sudden was at nearly 120, 300% increase in less than a year, to me was never sustainable. And it's anybody's guess as to where this is going to go from here on in. I would suggest that high here will get a retest and that low there will get a retest. So we're right kind of in the middle of that. And I think this is probably going to go range bound for a while until we get the next catalyst that drives it up or down. And that's my best guess on that. Gold, I'd probably be less of a trader on and still just hold it. I do think it will try test that high again. Personally myself, so I will be less concerned about gold because the move up hasn't been as aggressive, but silver was so aggressive, it was always going to correct, and it wouldn't surprise me, guys, if it came down to 60 even. Like it could come down to that 200-day moving average and still be in an uptrend, you know. So like, I mean, just be careful there. Just want to flip back then to some of the stocks that we had flagged and we were kind of holding out for. So Dell was one of them. So the good news there, Dell is selling off 4% today. So it's at 119 in pre-market. So we were waiting on this to finish. It's finished. I wanted to see some time of consolidation outside of it. Made a bit of a run, wasn't going to chase that run, and now it's back down. So we'll probably, if this continues, might pull the trigger on that in the next day or two. Oracle is another one that's getting very close to breaking out of its downtrend. These are, by valuation metrics, severely undervalued at this moment in time. But just remember what's going on with Oracle in particular. You know, there's big question marks over whether AI is going to eat some of its lunch. So just be careful on that one. Dell, it's more a margin issue. Will they? We know the demand is there for their products, so that's not a problem. It's whether the cost of the raw materials are so great, it's eating too much into their margin. And again, PayPal is a great example as to why we wait for trends to end, because look what happened to PayPal after earnings. Big wallop, and we come down here to lift. Another one, we said we wait for the downtrend to end. Look what happened, lift after earnings. So again, that's a real stark reminder of what can happen in individual stock after earnings. So just be mindful of that. Nvidia is one, like Nvidia and AMD. I think the earnings announcements over the last number of weeks, which is basically talked about increase in AI spend from Microsoft, Meta, Alphabet, I think it bodes well for those two stocks. So really, it's just a case of timing an entry point here in both of those. And I'm doing a scan at the minute. I was going to do that today, but I won't have time. But literally, there's another 15 to 20 stocks that have started to come up on my scan. So this is a kind of you know, for people who are interested in building a longer term investment portfolio, we keep an eye on these ones. And then one final stock that I wanted to mention, if people are interested in trading, right? So day trading and trying to trade something for a couple of days. I'm not a fan of it anymore, guys. So I'm just being straight up with you. But this particular stock here, NNE, the financials on it are terrible. So don't depress yourself by looking at the financials. They're not making money and their revenues are tiny. But what do? They're kind of micro nuclear reactors. And if you're looking to the future, in my opinion, that's where the future of energy is going, as national grids can't keep up and with what the demands that's been placed on them from data centers and everything else. So these kind of micro nuclear reactors to power data centers, etc., are probably the way to go into the future. And that's what this stock does, right? So if you were looking for a stock to play around with, and I want to be stressed, this is high risk stuff. This move from here to here, guys, is 45%. It's huge. It doesn't look like a lot in a chart, but this is moving 5 to 10% a day, up and down. So don't even bother looking at the financials. They're terrible. They're issuing more shares all the time, issuing more debt all the time to finance itself. But if some of you are out there looking for stuff to trade and you need something to move aggressively, NNE is it. I will be keeping my allocation well below 2% in that. So if you've got a 100,000 portfolio, I wouldn't be putting any more than 2 grand into something like that. And I will be trading it as such. Okay. So I just thought I'd mention that because a lot of people are asking me saying, look, Steve, I want to do a bit of trading. If you're looking for something that moves aggressively and maybe it's the future technology, there's a stock that you could look at and start doing your own homework on. But bear in mind, like that move yesterday is only a 1.2% down move, right? At one stage, though, it was down 7%. The day before that, it was down 7%. The day before that was down 2%. The day before that, it was up 11%. This is what you're talking about with this stock. So if you're looking to make quick 2 and 3% gains, maybe a stock like that is something you could look at. Any questions, folks? Anything else you want me to cover?
One question.
Yeah.
For this selling puts, I'm using XSP, and you
Yeah.
can only settle it on expiration date. And so, what if it bombed, and you then it's in the money? Why can't you roll it out and down and when it's in the money?
Okay, you can roll it out. It's how far down you can roll it. So let me look at SPY here as an example. So I'm going to pick an in the money put on SPY here, right? And let's see what the current quote is. So let's look at the 705 here, Stephen. And this should explain it. I'm just waiting on it to pop up. So the price at the 705 put for the end of February is 14.20. Can you see that?
Yeah.
Okay. Now, let's see where we can roll that to in March and get 14.20 in. Okay. So we go to March the 31st. Sorry, I'm just waiting on these prices to load. So do you see what I mean? We're not getting to roll it down very far. you're going to see the prices were still like, this is the problem. And the reason for that is there's lots of intrinsic value in the put option now. Does that make sense? So look, we could roll it down to 694 from 710. So now if we benchmark that against, I don't know, let's say, let me go back to February, just to give, because it's a great question, by the way. If I go back to February the 27th, let me look at something like even the 660 put here. So 180, okay? So we go to March, you can already guess you're going to be able to roll it down a lot further. So when you go in the money, it's because the put option is what we call intrinsic or real value in it. It's harder to roll it out and down because there's too much real value in the option and not as much time value anymore.
So it's more expensive?
Exactly. Exactly. It's costing you more to buy it back and you're not getting as much in for going out of the money anymore. So you can see here with that example there, we could be rolling this down to the low 600s. And that's the reason why you do this before the share price drops. So that's the key to this, Stephen. You must roll it out and down before the share price goes in the money.
But as an alternative to settling, it might still be attractive, no?
Sorry?
But you'd lose more money if you held on to it in those circumstances.
But not necessarily. It depends what you would do. You know, it's not necessarily. So it would really depend on a number of factors. Where is it at? You know, what's the news flow out there? You have to assess it all on each individual merits. You know.
Okay. All right. Thanks.
No problem, Stephen. Okay, guys, that's it from me. Unless you have any other questions.
Yeah, one very last one, Stephen. So the consensus view out there appears to be that the US dollar is going to weaken further over the next year. Any comment on that?
I wouldn't be so sure. Like, you know, the only reason that would happen is if interest rates were being slashed and if the US economy went into the toilet, in my opinion. So I'm not so sure either of those things are going to happen, you know. I wouldn't agree with that really.
Okay.
I think we're going to be range bound pretty much between 116 and 125. That okay, Brendan?
Thanks. Okay.
No problem. Alrighty, guys, I'm going to leave it there. Again, as per usual, if you have any questions, just let me know. Brendan, are you going to hang on here?
Thanks, Steve.
Thanks, Stephen.
Thank you.